Hello viewers, welcome back to our YouTube channel, KC Accountants Education Center. Today we want to continue with our series of advanced financial management. And in the previous video we had looked at how you can be able to estimate or compute the risk and expected return of a portfolio. We looked at different methods and we want to conclude with the aspect of how we can be able to interpret the results. So interpretation of the results. Interpretation of the results using portfolio theory. So we had looked at the aspect that we had formed our portfolios. So we had looked at having a school and shares, having a school and a pharmacy, having shares and a pharmacy. So just assume that these are the three investment ideas that we have. But just know, as an investor, you need to select one portfolio of the three. So we have investing in a school and investing in shares as our first portfolio. Then the second portfolio is a school and a pharmacy, then shares and a pharmacy. Now, we looked at the different formulas that we can use to compute the expected return and then the risk. But now, once you have used those different formulas, we can use convariance. We can use convariance to make a decision whether we take up this investment project or we take up the other. So we can use convariance to determine which portfolio we should go with. So not forgetting that we had already formed our different investment portfolios. And all of these three investment portfolios that we had formed, we compute the expected return for each of those investment portfolios. Then we see how we make a decision basing on the results that we have gotten from the different computations that we have done. So the examiner is going to be telling you to advise whichever company or whichever investor they are dealing with in the question on which investment project they should undertake. We also saw from our previous videos that we can use mean to variance relationship. Mean to variance relationship. We can also use it because we used this under the single asset or one line of business, when the investor is only investing in that one line of business. We can also still use it here under portfolio. But the only way or the only option that you have for you to use mean to variance relationship under a portfolio analysis is only when the examiner has told you to use mean to variance relationship. So if the examiner doesn't tell you, if the examiner doesn't specify that you use mean and variance or mean to variance relationship, then you shouldn't use it because it is a little bit limited. it can give you unrealistic results if you base on its assumptions. Meaning when you have, because now if you are to go by the mean to variance relationship, you compute the expected return of a portfolio, and then you also compute the risk of that portfolio. If it is portfolio 1, you compute the expected return of that portfolio, and then you compute the risk of that portfolio, and then you see which one has the highest risk. Because with the mean to variance relationship, we expect that the higher the risk, the higher the returns. That's the assumption. So you look at which portfolio has provided me with a higher risk percentage. Of course, we computed these and we converted them to a percentage. So which one is giving me a higher percentage of risk? You don't look at the return. Even if the investment has 100% return, but its risk is let's say 5%, we take up the other investment which has a higher risk, because that's the assumption of mean to variance relationship. So you look at the expectations are higher returns, as they are going to come as a result of taking up businesses that have a higher risk. The other that we used in the other side of single entry, we used what we call the coefficient of variation. This one we also looked at it under the single entry, but we can also use it here to make a decision. So these two, we used them when we are dealing with a single entry. And the coefficient of variation for it looks at that investment project that has the lowest coefficient of variation. But these two, we only use them when the examiner has told us to use them, because these other methods, using convariance or using the correlation coefficient, they give a more realistic figure. It can enable someone to make a reliable decision because of the results that they are providing. So once you have the convariance and you also have the correlation coefficient, it's better you make the decision basing on the results of those two. So we need to see how do we make a decision basing on convariance or basing on correlation coefficient, because they are the ones that are giving a more realistic figure. So let's begin with convariance. How do we make a decision? Now, convariance, it shows movement. It's more of movement or spread. It shows movement. Now, the answer could be a positive convariance, or it could be a negative convariance. So if you are going to be using convariance to make decision, then you are going to select that investment portfolio that has a negative convariance. So the portfolio that has a negative convariance is considered to be better. So if you get a positive convariance in one portfolio, then it means that that portfolio is not is not good for investment. So the best option is for you to take the one that is giving a negative convariance, because it will be good for making that investment. Because someone is going to be wondering, how is it going to be good if at all I've computed the convariance of a portfolio and I've gotten a negative convariance. The argument here is that these remember we are selecting two different projects. It's going to be either, let's say, a school, maybe an investment in shares. So these two projects are going to be moving in opposite direction. So we are going to have an opposite movement. If this one is going this side, then this one is also going to be going the other side. They are not moving in the same direction. They are moving in opposite direction, because I told you that convariance only measures movement. Is it going in the opposite direction or it's moving in the same direction? So if let's say this school makes a loss, because you have a school and it has made a loss, the implication is that the other business will not make a loss, it will make a profit. That's the kind of movement that we are talking about. That if this company makes a loss, the other one makes a profit. Remember, we are taking two investment projects. If investing in a building will make a loss, then investing in other, let's say in a school, it will be profitable. So there is opposite movement. They don't move in the same direction. But for a positive convariance, it means that they are moving in the same direction. The implication is that if I have decided to invest in a school and at the same time I'm investing in shares, once I make a loss in a school, I will also make a loss in shares. That is when you have gotten a positive convariance. That's why it is better if this business is making a loss, the other one is making a profit, because the other profit will compensate the loss that you have incurred in the other side. That's why it is better to take up the portfolio that has given you a negative convariance. So that's the difference. If you are to look at which portfolio should I take based on the convariance that we have computed. So now we want to look at the correlation coefficient. How do we make a decision based on the correlation coefficient? So we know from statistics that these are just they are more like probabilities, but these ones we can have negatives. The only difference is that we can have some negatives. So the general rule is that for the correlation coefficient of the two projects, it should be greater than or equal to +1, but less than or equal to -1. In other words, it shouldn't go below -1 and it shouldn't exceed +1. So it is just in between there. So the question is, what is going to be the best option? So it is also going to have a positive, it can give you a positive, and at the same time it can give you a negative answer. So if we get a positive answer, what is What is the implication? But the bottom line, it shouldn't exceed 1. Either -1 or a +1. It shouldn't. So if you see that it is actually exceeding that range, then you just know you have just made some errors. So it is going to be moving in a sense that we can move from 0 to the negatives. Maybe we can have, let's say, -0.5. Then this is -1. Here we have positive 0.5, then +1. Now, how do you make a decision? Of course, this is going to be negative correlation. Here we have a negative correlation. The whole of this item here is a negative correlation. So the whole of this side is going to be showing us a positive correlation. So even within this, if it is maybe -5 going to -1, this one is going to be strong negative correlation. If it is between -0.5 to 0, then it's going to be weak negative correlation. Once it is in between 0 to 0.5, that is positive. It is weak positive correlation. So if it is positive 0.5 to 1, then it is going to be a strong one. So it depends on the answers that you have gotten. So of course, with our advanced financial management, the basis on whether the result is a positive or it's going to be a negative, that's where we put our emphasis, to have a positive or to have a negative. But now, we don't go into deep analysis of whether it has given us a strong negative correlation or it has given us a weak correlation, but we are just taking the general picture. Is it a positive correlation or it is a negative? That's it. But if you understand the whole argument of whether you have a strong and a weak, you can explain it in your comment. That even though it is a negative, but it's a negative, but it is close to -1, so it is a strong one. So for us, we just look at, have we gotten a negative correlation or we have gotten a positive correlation? And of course, a proper investment portfolio is the one that has a negative correlation. So the best option is for us to have a negative correlation. We don't care whether it is strong or weak. As long as we have gotten a negative correlation, then we can say it's good. Because also this one is basically looking at the movement. We are going to, if we have a negative correlation, it means these investment projects are also moving in an opposite direction. If you make a loss the other side, this side you are going to make a profit. So the negative one is better because it's going to be, it means these investment projects are moving in an opposite direction. If you get a positive correlation, then it means that these investment projects are actually moving in the same direction. If you make a loss in this investment, then even the other investment, you are also going to make a loss. So that's how we interpret the results that we have got from the different computations based on the method that we are going to use. I've told you we can use mean to variance, we can use correlation coefficient, we can use coefficient of variation, we can use convariance, we can also, based on the convariance, to make a decision. So next we are going to be looking at a simulation to help us understand, or we put what the different methods that we have been seeing. We are just going to look at question 2, November 2016. It's the one that will help us to go through the different formulas. But one thing to note is the fact that we will not be asked to do what we call the risks and return of a single asset. That was supposed to be for financial management on level 2. Level 3, it's portfolio analysis. In other words, you look at more than one investment project. And even if the examiner gives you, let's say, 3 investment projects, we don't have a formula as per your syllabus for computing the risk, because the problem is just on the risk of a portfolio for a project that has 3 investment assets. That's why we are restricting ourselves to only 2. If the examiner gives you more than 2 investment assets, then the interpretation or the approach is for you to make different, like you form your own investment portfolios. If they give you 3, then you make pairs so that they become 2, and you compute each of those portfolios to determine which one the business can undertake.